Are you ready to take control of your financial future and live the life you've always dreamed of? You know, the one where you're financially free, you can pursue your passions, and you're not stressing about money every single day? Well, investing is absolutely essential to making that dream a reality, and that's exactly why I'm here today. In this video, we're diving into the top 5 ETFs to invest in for 2025. We'll break down each ETF, talk about its strengths, and why it deserves a spot in your portfolio. These ETFs represent different sectors of the market and offer diversified growth potential, which is key for long-term financial success. Remember, this isn't about getting rich quick. This is about making smart, strategic investments that will help you build wealth over time. Stay tuned, because these picks could be the key to unlocking your wealth and achieving the financial freedom you deserve. Let's get started. Let's kick things off with a true heavyweight. In the ETF world, the Vanguard S&P 500 ETF, also known as VOO. This ETF tracks the S&P 500 index, investing in the 500 biggest publicly traded companies in the US. Think Apple, Amazon, Google, Microsoft. With VOO, you get a piece of all of them. The S&P 500 has a long and impressive track record. Over the past decades, it has delivered an average annual return of around 10%. That means your money could double every 7 years on average, thanks to compound growth. Of course, past performance isn't a guarantee of future returns, but here's what sets VOO apart: its stability. The S&P 500 is incredibly diversified. It covers a wide range of industries, from technology and healthcare to finance and consumer goods. This diversification helps to reduce risk. If one sector is struggling, others might be performing well, smoothing out the ride for your investments. And when it comes to fees, VOO is incredibly cost-effective. It has an expense ratio of just 0.03%. which is insanely low. For every $10,000 you invest, you'll only pay $3 in fees per year. Low fees allow more of your money to work for you, compounding over time. So, whether you're just starting out or you're a seasoned pro, VOO is a fantastic foundation for any diversified portfolio. It's like the rock-solid base upon which you can build your financial future. But don't just take my word for it. Do your own research. Understand the risks and potential rewards, and decide if VOO aligns with your investment goals. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions for long-term financial success. All right, now let's shift gears and talk about an ETF that's all about growth and innovation: the Invesco QQQ Trust, better known as QQQ. This ETF tracks the NASDAQ 100 index, which is heavily weighted towards technology companies. We're talking about the companies that are shaping the future, from artificial intelligence and cloud computing to electric vehicles and renewable energy. Now, the tech sector has been on an absolute tear in recent years, and QQQ has been along for the ride. It has consistently outperformed the S&P 500, delivering impressive returns for investors. But it's important to remember that past performance is not indicative of future results. The tech sector can be volatile, with periods of rapid growth followed by corrections or pullbacks. But here's the thing: technology is only becoming more integrated into our lives. Think about it. Smartphones, social media, e-commerce, these are all driven by technology, and that trend is only going to continue. As technology advances, the companies in the NASDAQ 100 are well positioned to benefit, and so are investors who hold QQQ. Now, QQQ is not as diversified as VOO. It's heavily concentrated in the technology sector, which means it carries more risk. If the tech sector experiences a downturn, QQQ will likely feel the pain. That's why it's important to consider your risk tolerance before investing in QQQ. But if you're looking for growth potential and you're comfortable with a bit more risk, QQQ could be a great addition to your portfolio. It's a way to tap into the innovation and growth of the technology sector, which has the potential to generate significant returns over the long term. Just remember, investing is a marathon, not a sprint. Don't get caught up in the hype or try to time the market. Instead, focus on building a diversified portfolio that aligns with your investment goals, risk tolerance, and time horizon. Alright, let's talk about an ETF that's not for the faint of heart. The ARK Innovation ETF, or ARKK. This ETF is all about investing in companies that are disrupting industries and changing the world as we know it. We're talking about cutting-edge technologies like artificial intelligence, gene editing, robotics, and blockchain. Now, ARKK is run by Cathie Wood, who's become a bit of a rock star in the investing world. She's known for her bold bets on disruptive innovation, and her track record has been nothing short of impressive. ARKK has delivered incredible returns in recent years, crushing the S&P 500 and attracting a lot of attention from investors. But here's the thing about ARKK. It's not your typical ETF. It's actively managed, which means Cathie Wood and her team are actively picking stocks, trying to identify the next big winners in the world of disruptive innovation. This active management style can lead to higher returns, but it also comes with higher risk. RKK is heavily concentrated in a small number of companies, many of which are considered high-growth, high-risk investments. These companies are often unprofitable, burning through cash as they invest heavily in research and development. This makes RKK a more volatile investment than something like VOO or QQQ. So if you're considering investing in RKK, you need to be comfortable with a higher level of risk. This is not an ETF for someone who's risk-averse or who needs their money in the short term. RKK is a long-term play, and it's important to understand that there will be ups and downs along the way. But if you believe in the power of disruptive innovation and you're willing to stomach the volatility, ARKK could be a great addition to your portfolio. It's a way to invest in the companies that are shaping the future and potentially reap the rewards of their success. All right, let's go global and talk about an ETF that gives you exposure to some of the fastest growing economies in the world, the iShares MSCI Emerging Markets ETF, or EEM. This ETF tracks the MSCI Emerging Markets Index, which includes companies from countries like China, India, Brazil, and South Korea. Now, emerging markets are countries that are in the process of becoming developed economies. They often have lower per capita incomes, but are experiencing rapid economic growth. This growth is driven by factors like industrialization, urbanization, and a growing middle class. Investing in emerging markets can be a great way to diversify your portfolio and potentially achieve higher returns. As these economies grow, their stock markets tend to outperform developed markets. However, it's important to remember that emerging markets also come with higher risks. Political instability, currency fluctuations, and regulatory changes can all impact the performance of emerging market investments. That's why it's crucial to do your research and understand the risks before investing in EEM. EEM is a broadly diversified ETF, investing in companies across a wide range of sectors, including technology, financials, consumer discretionary, and materials. This diversification helps to mitigate some of the risks associated with investing in emerging markets. If you're looking to add some international exposure to your portfolio and you're comfortable with the risks involved, EEM could be a great option. It's a way to tap into the growth potential of some of the world's most dynamic economies. Just remember, investing in emerging markets is not for everyone. It's important to consider your risk tolerance, investment goals, and time horizon before making any investment decisions. All right, let's wrap things up with an ETF that's all about building wealth through the power of dividends, the Schwab US Dividend Equity ETF, also known as SZHD. This ETF focuses on high-quality, dividend-paying companies that have a long history of consistently paying and increasing their dividends. Now, dividends are essentially a share of a company's profits that are paid out to shareholders. They are like a bonus for owning a piece of a company that's doing well. And the great thing about dividends is that they can provide a steady stream of income, which can be especially helpful during market downturns. SCHD invests in companies across a variety of sectors, including consumer staples, healthcare, financials, and industrials. These are typically well-established companies with strong track records of profitability and dividend growth. One of the key benefits of SCHD is its low expense ratio at just 0.06%. It's one of the most cost-effective dividend ETFs on the market. This means more of your money is working for you, compounding over time and generating potentially higher returns. Investing in SCHD is a great way to build a passive income stream and potentially grow your wealth over the long term. Dividends can be a powerful tool for investors of all levels, whether you're just starting out or you're a seasoned pro. Just remember, like any investment, SCHD comes with risks. The value of your investment can fluctuate, and there's no guarantee that companies will continue to pay or increase their dividends in the future. But if you're looking for a way to generate passive income and potentially boost your returns, SCHD could be a great addition to your portfolio. It's a way to invest in high-quality companies that are committed to rewarding their shareholders. So there you have it, our top 5 ETFs to invest in for 2025 and beyond. Remember, these ETFs offer a great starting point for building a diversified portfolio that aligns with your financial goals. Whether you're looking for stability, growth, innovation, international exposure, or dividend income, there's an ETF out there for you. If you found this video helpful, make sure to check out our next video on Are Hidden Fees Eating Away Your Credit Card Money? Click on the end screen to watch now and take another step towards financial freedom. We'll dive deep into those sneaky fees that can drain your bank account and show you how to avoid them. Don't forget to like, subscribe, and hit the bell icon for more insightful content. We're here to help you make smart financial decisions and achieve your financial dreams. See you in the next video.